Joining us at our opening exchange is Dan Niles, the founder and portfolio manager at Niles Investment Management. Dan, come on, the earnings alone. This is not pets.com when everything, had a couple dollars of cash flow and was tripling overnight. Do you really see the similarities between the behavior of these stocks now and then?
Absolutely, but it doesn't mean this can't continue. And that's the analogy I'd like to make, because if you go back to the internet build out, so you had the Netscape Navigator come out at the end of 1994, and the NASDAQ over the next 3 years was up 109%. You get to year 4, though, and NASDAQ was up 40%. And then in year 5, in 1999, it was up 86. So you look at when ChatGPT came out at the end of 2022, and you're 3 years into this, NASDAQ is up 122%. So first 3 years of the internet was up 109. And I think this is going to be a great year as well. And the point is that you had 2 more great years back during that period of the internet build out. And I think you at least have 1 more great year this year. So you can be in a bubble, but still have it inflate a lot more before you get to the end of that.
What caused it? And I will add as well, I have only vague memories of it, but they were enough to know. Back in the era of magazines, right? You'd get these magazines and you'd have these cover stories of all these high-flying companies, and everybody was day trading. It was a total phenomenon. I'm not sure we're there yet with the public right now.
No, absolutely not. But more important than that is what's going on fundamentally. Back then, it was just internet traffic doubling every quarter or so. And that kind of kept it going. This time, you had a very major event happen at the beginning of this year, and that's basically OpenClaw got finalized on January 30th. And so that kind of ushered in this whole agentic AI thing, where before, Kelly, right, you would ask your ChatGPT or Gemini a question, and it would give you an answer. So that's just chat-based AI. Mm-hmm. With agentic, you may say, hey, go to the SEC website, pull this down. Go to CNBC, pull this down. Go to, whatever website, pull down some stock information, and then put it all in a spreadsheet, and I want you to conform it this way. That takes 10 to 100 times more compute power to have that happen. And you can see it in the token generation data, where the 2 months prior to OpenClaw being finalized, token growth was about 20% over the prior 2 months. In the 2 months after OpenClaw was finalized, the growth was over 120%. And so you should see at least strong growth, in my opinion, through the beginning of next year. And then you're going to lap those harder comparisons, and then we'll see what happens. But that's one major difference, at least between now and I think year 4 and 5 of the internet, is you have this major step change in token generation that you need right now.
Remind me, what was it that kind of pulled the rug out from under the tech trade bag? It was March of 2000 that things peaked? Do you remember if there was a story or a data point?
Oh yeah, no, there's 100%. You got to remember what kicked the bubble off. Believe it or not, in 1998, the Fed was cutting rates. So easy money kind of kept going. And then in 1999, even though the Fed ostensibly started to raise rates starting in June, remember there was this thing called the Y2K scare, right?
Oh, yeah.
You were going to get to 2000, computers were going to crash around the world. So the Fed was flooding the markets with money underneath this. And so M2 money supply was up over 10%. And so that kept lifting that. Then you got into 2000. Oil prices, by the way, spiked. And then the Fed started withdrawing that liquidity because computer systems did not crash on January 1st of 2000. And so you take away those two things, internet traffic went from doubling every 3 months to doubling every year, which isn't bad. But that slowdown was not what was built into the valuations. And then NASDAQ went back down to where it was in the middle of 1996, declining 86% over 2.5 years.
And then
that's the other side of it. Built into the valuations. And then NASDAQ went back down to where it was in the middle of 1996, declining 86% over 2.5 years.
And then
that's the other side of it.
Hey guys, welcome back to my channel. I hope you are learning well today. So without wasting time, let's start our video. Over the past few weeks, investors has been become increasingly nervous. Rising oil prices, Middle East tensions, interest rate uncertainty, and massive IPO competing for capital. And the market is sitting near the record high. Under the normal circumstances, those would be enough reasons for investors to take profit and move to the sidelines. And yet, despite all those concerns, one thing continues to stand out. The demand for AI infrastructure remains relentless. And that's exactly why Nvidia long-term story may be stronger today than it was in 6 months ago. While much of Wall Street focuses on short-term market volatility, Nvidia continues expanding its footprint across nearly every major area of artificial intelligence. One example emerged this week is through Apple growing AI ambition. Nvidia confirmed that its Blackwell GPUs combined with confidential computing technology running on Google Cloud will help support portion of Apple next generation AI infrastructure. At first glance, this may not sound like a major development, but the implication could be enormous. Apple serves billions of devices worldwide. As AI capabilities become integrated into the CD and future Apple services, every new feature has been potentially to create additional inferences demand. And inferences is where the next phase of AI revolution is unfolding. Training models get the headlines, inferences generate the revenue, and every AI response, recommendation, actions, or decision require the compute. As billions of users begin to interacting with AI-powered services every day, the amount of compute required could increase dramatically. That's why many investors believe the market still underestimate how large an inferences opportunity may be become. Meanwhile, demand continues spreading across the broader AI ecosystem. Google recently introduced a new AI technology focused on faster text generation and more efficient model architecture. NVDA immediately moved to optimize those capabilities across its hardware platform. This highlights one of the NVIDIA's greatest strengths. The company isn't waiting for AI innovation to happen, it's actively positioning itself at the center of nearly every major advancement. Whether AI run in the clouds or enterprises infrastructure or directly on personal devices. NVIDIA wants the hardware and software powering the experience, and the demand signal keep getting stronger. This week, Supermicro announced billions of dollars in financing to support a massive backlog of AI service order. Think about what that means. Companies aren't raising capital because demand is weak. They are raising capital because demand is overwhelming their ability to deliver the product fast enough. That distinction is critical. Throughout the technology industry, the conversation has shifted. The debate is no longer whether AI adoption will happen, the debate is whether the industry can build capacity quickly enough to keep up. That the same theme appeared in the Oracle latest earning report. Management discussed enormous demand for cloud infrastructure and indicated plan to accelerate capacity expansion. Importantly, the increased spending isn't driven by the higher component cost. It being driven by urgency. Customers want access sooner, demand